So I want to thank everybody for taking some time today to listen to what I have to say about the previous quarter and what's going on in the world, in the market, the economy, etc. So thanks for joining us. Um, Let me switch over to our PowerPoint and we will get started. All right, there we are. For those of you who haven't joined us before, I'm Pete Krull. I am a partner and director of sustainable investing at Earth Equity here in Asheville, North Carolina. We'll start out with some disclaimers. I'll let you take a second to read through that and that. And we are going to do a little bit different agenda than we normally do. Because there are a little bit different circumstances this month, this quarter, than there was previously. So normally we have a sort of a menu that I go through with each one of these quarterly calls, but we're going to go change that up a little bit this time. So I'm going to give you an Earth Equity update, and then we're really going to jump into markets, economic update. Obviously, we're going to talk about tariffs and things. We'll get into fund performance, any of the changes and things that we might have made a week or so ago at the beginning of the quarter. And what's going to be probably a little bit more different than normal is the first part is going to be a little shorter, and that's going to leave more time for us to do a Q&A. I've got a bunch of emails from folks over the last couple weeks here, as has Neil, Carey, and Rebecca. And so we're going to try to answer as many of your questions as possible. So, make sure that you are getting those ready for us. There is a question and answer section where you can put your questions. Actually, I think you can put that in the chat, it looks like. So, you can start doing that now if you need to. Yeah, no, there is Q&A as well. So it looks like somebody's already got a question in there. So we'll get that when we get to the end. Anyways, so quick update. I'm continuing to do some speaking gigs around. I spoke at the Titan Investors Conference in January over in Charlotte. I spoke at Futureproof. Futureproof is sort of the premier financial services conferences, and there are three of them a year right now. This one was actually held on Miami Beach, not in Miami Beach, but literally on Miami Beach. This was the Sustainable Investing Panel. There with a couple of folks who are, let's see, on the right is a gentleman from Community Capital Management, which is a fund that focuses on Community Reinvestment Act. And Blair on the left is a financial advisor with Ritholtz Wealth Management, which is the company that puts on the event. We rebalanced the fund portfolios on April 1st, and I'll get into details a little bit about what we did. I did get finished up the Sustainable Investor. This book will be coming out in October. I finished it and submitted the manuscript to the publisher Wiley. So that's an exciting event for us. And I put this up last month. We are continuing to actively hire financial advisors, folks who currently are advisors and want to transition to be sustainable advisors. So we're excited to continue to grow our team. These are, let's see, this is the first quarter of the year. And you can see the first quarter actually was not horrible, especially for international. International stocks were up almost 8% in the first quarter. Emerging markets up about 4%. But we can see also that domestic small caps down about 10%. The S&P 500 down about 4%. And for the first time in a long time, clean energy actually outperformed the S&P 500. So that was exciting to see. When we take it out a year, of course, clean energy does not stand up, but S&P 500 up about 8%, international stocks up about 5.5%, emerging markets up just shy of 9%, and bonds up 5%. That's really nice to see. Small caps, again, did not perform exceptionally well at -4%. But again, bonds is nice to see. I know with some folks, we have used some individual stocks, or I'm sorry, individual bonds, where it was appropriate because of the rates. And so that has actually worked out fairly well. When we go out 5 years, we can see that the S&P 500 continues to outperform. This purple over here was clean energy, especially from 2020 going out of the right into the middle of the pandemic here, and then really has simply not performed over that time. What else do we have here interesting? International up 75 over that time, emerging markets 42. Bonds have not performed, partly because of the kind of interest rate environment we've been in. They have obviously performed better over the last year. And when we take this out to 10 years, you can see the S&P, which is, again, going to be dominated by a lot of the larger tech companies, have an undue impact and influence on how this index performs. So let's just jump right into tariffs right now. And I'm just going to give you just a very quick primer for those of you who don't necessarily understand what they are. So basically, they're taxes on imports imposed by governments to raise revenue, protect domestic industries, or exert political leverage over another country. This is from Investopedia. Thank you, Caleb. That's the basic idea of what they are. They're a way to maybe raise revenue, maybe protect your domestic industries. And as we're really sort of seeing in China right now, the exert political leverage certainly is what we're seeing with that country. But unfortunately, they often result in unwanted side effects, such as higher consumer prices, which we haven't seen yet, but we likely are going to see in the near future. So the question is, why is the administration putting these tariffs in place? And there's a number of different reasons that we've been able to divine out of the communications. One is trying to reshore manufacturing to the U.S. Second, to reduce trade deficits. Third, to counter other tariffs that foreign countries have. Fourth, to pay for tax cuts. And fifth, as a negotiating tool. And we're going to cover each one of these here shortly. So reshoring manufacturing to the U.S. So since the 80s, and probably even before that, we have made an effort to move manufacturing offshore. Why? Because it's cheaper. We like our inexpensive goods. Manufacturers don't want to spend as much on labor. They don't want to deal with environmental regulations and things like that, and so they will offshore to China, to other countries in Southeast Asia. We see some of that in Mexico as well, and other Latin American countries, and it's been happening for decades, and it's going to be very, very hard to turn that around. There's two ways to do so. So the first is the carrot method. Incentivize companies to build factories here in the U.S. And we saw that during the previous administration with things like the CHIPS Act and the Inflation Reduction Act, which really put incentives in place for companies to move manufacturing back here to the U.S. And we saw it especially in things like the EV industry with batteries and those industries, as well as chips like semiconductors. Taiwan Semiconductor is putting multi-billion dollars into new plants here because there were incentives to do so. The second method to reshore is the stick method, and that's imposing tariffs to sort of force countries to build or companies to build factories in the U.S. because they don't want to have to pay the tariffs that are being for importing goods into the country. And that is really what we're talking about right now. We're using the stick as opposed to the carrot. When we look at exports as a percentage of GDP, so from the U.S., we only about 11% of our GDP are exports versus say South Korea, which it's well over a third of their GDP is in exports. The EU is a considerable amount. And you can see where everything is related to the U.S. Surprisingly, China, only 14% of their GDP is in exports. And a fairly small portion of that, relatively speaking, is to the U.S. Now, it's a big number because we do have a lot of imports coming in here. But you can see that there's not a whole lot of exports that the U.S. Puts out there, and so the amount of tariffs that were charged internationally, relatively speaking, is not that high. This gentleman here wrote one of the papers that the White House used to create their uh, calculations. He's a professor of economics at the University of Chicago, and he talks a little bit about trade imbalances. So the second justification for the tariffs was to reduce trade deficits. And I hate reading PowerPoints, but I'm going to read this one because I think it's important. So he said trade imbalances between two countries can emerge for many reasons that have nothing to do with protectionism. Americans spend more money on clothing made in Sri Lanka than Sri Lankans spend on American pharmaceuticals and gas turbines. So what, he says. That pattern reflects differences in natural resources, comparative advantage, and development levels. Deficit numbers don't suggest or let alone prove unfair competition. It's just that there are different things that each one of these countries are able to provide. Sri Lanka is able to provide low cost labor. I'm not saying that's right or wrong, but that's just sort of the basics of why what he's talking about right here. And when we look at things like mining, for example, here, the U.S. is in this olive color here. So when it comes to rare earths, we're producing 11%, copper 5%, zinc 6%. Really, there's nothing that I can see here in nickel, and nothing I can see in cobalt. And so we have to be importers if we're actually going to be, manufacturing stuff here. A lot of these go into things like batteries and electronics. And so in order for us to actually um, you know, build the things that we want to build here, we need to get the raw materials to make that happen. And when we look at semiconductor production by location, you can see back in the 90s, we made a third of them here, and now it's down to about 14%. It's kicked up, or it's going to kick back up here with some of the CHIPS Act. But even with those kinds of incentives, it does take a long time for that to build up. So, assuming that we can change our economic makeup by bringing manufacturing back in the short term just isn't reasonable. That is something that is going to take years and years to do. I think it's important that we are as self-sustaining as possible, and we really learned that during the pandemic when there was a number of things that were important for medical care that we weren't able to access because it was manufactured outside the country. Likewise, during Hurricane Helene, there were some medical devices that were manufactured only in one place that were impacted by the hurricane that weren't being shipped out because there was a problem with the manufacturing plant. So diversification of manufacturing capacity is just as important. I sat in on a webcast with Dr. David Kelly, who's Chief Global Strategist for JP Morgan. So one of the rationale was to counter foreign tariffs. He said, tariffs are like a grenade in a small room. They'll turn out badly for your rivals, but they'll turn out badly for you too. And I thought that was a great way to put it. He said the average U.S. tariff is 2.2%. He said the average trade partner tariff, so partners around the world, is only about 4.6%. And that, if we had simply increased tariffs by 2.4%, then it would have made this quote unquote reciprocal tariff. But they used what he called a strange and bizarre formula to calculate the tariffs. And, him, a number of economists, again, the gentleman who I referenced earlier, who wrote one of the papers that they referenced, can't quite figure out how they came up with the numbers. And when you look at so the line of reciprocity here is this line going up the middle here. And so, yes, you can see that, tariffs that are imposed on us are, below that line, which means that they're a little bit more than what we are charging. But for the most part, if you look in this under 5%, the vast majority of countries are not imposing anything that is, crazy, 20, 30, 40%. The only two, well, I'll throw Brazil in here, but the only three countries where you see, some major differences from this line of reciprocity is Brazil, India, and China. China is, right now this is, as of April 10th, which is today, there are well over 100% tariffs that have been placed on them. Probably not quite, because if you look at this chart right here, the tariff imposed on the U.S. looks to be about 18%, give or take. So, if the line of reciprocity would probably come in, somewhere around here, they would need to reduce, we would need to raise. That's the issue. But, most countries, the EU, Canada, Mexico, countries that we really have good relationships with, don't really have a problem with countering their foreign tariffs. And I will say this, so I made this PowerPoint 3 days ago, 2 days ago on April 8th. And of course, April 9th, yesterday, the administration announced that they were putting a 90-day hold on tariffs, which the presentation was already through compliance, so I couldn't really make any changes to it. But it doesn't really change anything if we assume that they are going to implement these tariffs in 90 days. What it did do was, crank the market up 12% in some case. I think that was the NASDAQ yesterday. But again, the day after, we've fallen back down again. So it's this level of uncertainty that I think all of us are dealing with and wondering, what's next. And there's really not a good answer for that. And when we look at this goes back to 1900. These are tariffs, and you can see we used to have high tariffs back in the day. This is where we've been down here, and the arrow I just showed is where things could be in 90 days from now once everything is put into place, or if everything is put into place. So we haven't seen tariffs this high in 100 years, basically, or over 100 years. Excuse me. Going back to the gentleman, the economics professor from University of Chicago, he asked, of course, how on earth did they calculate such huge rates? Because he said their finding suggests the calculated tariffs should be dramatically smaller, perhaps 1/4 as large. And we could see that on that reciprocal tariffs chart that I just showed you. And he uses a negotiating tool. So, the Treasury Secretary Scott Bessent came out and said, and this is in the Journal, I think you're going to see some very large countries with large trade deficits come forward quickly. They come to the table with solid proposals. I think we can end up with some good deals. So whether this plays out or not remains to be seen. I think that's, theoretically, or at least what they're saying is the reason why they delayed it for 90 days. But that story can change anytime. It's really it's hard to divine what's going to happen because the story is consistently changing here. And so the market reaction. So this is a chart from April 1st through April 8th. And you can see that over that time, the S&P was down almost 10, international stocks down about 10, emerging markets down 9, bonds off just a little bit, small caps off 10. And once again, interestingly, clean energy didn't do as badly. So, down about 5.25. Well, we will certainly take that. So the market reaction, I just pulled up some headlines here from the Times, Bloomberg, and the Journal that I think I got these all near the 7th or the 8th. Already reducing car imports and idling factories. Stocks churn as traders seek clarity on the rollout. Bank of Canada expects inflation, and I think pretty much everybody expects that as well. One of the things that I actually expected to happen sooner, but it took a while, is for CEOs and other Wall Street types to become a little louder and create a little bit more pushback. And we've finally started to see that. We're actually even seeing it from our senator here in Thom Tillis here in North Carolina, who said, "Who do I choke if they backfire?" But yeah, everything from oil executives, the price of oil has dropped tremendously. And Jamie Dimon, Bill Ackman, these folks who are sort of mainstays in the financial community, they are pointing out that, hey, this is possibly going to cause a recession. This is likely going to cause inflation. And, I think, I would hope that, some of this may have pushed the 90-day reprieve. No way to really know, of course, but these are the folks who have been doing this a long time, and they haven't been able to find a rationale that made sense for the tariffs, like we've really sort of shown as we've gone through some of these slides here. Barron's said, for lower income households, tariffs will act as a tax on imported goods and drive prices higher. It'll crimp household spending and business investment, which ultimately could lead not just to inflation, but to a recession as well. People can't spend if they're not employed, so job numbers will also be something important to watch. And when we look at some of these numbers from JP Morgan here, we can see that consumer sentiment has fallen off this year. We can see that business optimism has fallen off as well. And these are going to be some important numbers to look at. These are charts, the last two that I normally have in our presentation. You can see that auto loans, credit card delinquencies are starting. I mean, they've started to rise going back to post-pandemic, but these are numbers we're probably going to start to see rise as well. I think the number I saw earlier, I saw a number earlier today that was talking about delinquencies on mortgages, I believe, are starting to rise as well. That's not listed. Yeah, it is listed on here, but they're starting to see more and more delinquencies on mortgages rising. And household debt service ratios, so in other words, the ability of households to pay their debt, still is a good number historically going back to the 80s, but we could see this rise as well. So for now, inflation is back to normal. The Fed came out, or not the Fed, CPI numbers came out today at about 2.4% for March, which is good. This is really where the Fed wants it to be. Price of gas was down over the month, but the price of food was up. As anybody who goes to the grocery store can see that prices of everything from eggs to bread and everything else is up, and so that's a big that's going to be a big component of inflation. This 2.4% though does not take into account any of the tariffs yet, and so it remains to be seen next quarter. This is probably something we will be talking about. And you can see here that, let's see, what's food? Food is purple. It's really sort of hard to see here. Not as bad as it was back in 2022, but still a component here. Excuse me, dining, shelter, you can see that cost of rent and housing has gone down. So that's probably one of the bigger reasons, in addition to gas, like I said, that we saw numbers come in pretty decent today. So how are we handling the current market environment? That's a great question. Thank you. So here's the moves we made. So our GreenSage sustainability portfolio is always fully invested in stocks. That's just the way that account is managed. And for the most part, it's not 100% of clients' portfolios. It is in some folks, and they understand the risks of that. We will rebalance that again in a couple months on June 1st. So for our fund portfolios, which is where we have the vast majority of our client assets, we rebalanced those on April 1st. We rebalanced those about a week and a half ago, with the understanding that there probably was going to be some volatility with the tariffs. So what we did was reduced some of our domestic allocation, so the allocation that goes to stocks in the U.S. We actually increased it for international, for both developed and developing markets international. And we've seen that that's actually been an asset class that's performed a little bit better during this time. Again, of course, it remains to be seen if that will continue. But if tariffs do get implemented and we do see inflation here, and we do see some of our trading partners or former trading partners start to exclude the U.S. or start trading with, in amongst themselves and start excluding us, that's probably going to be better for those economies. And so we want to make sure that we've got a little bit better, a little higher allocation there than we normally do. It's not huge, but it's enough to, sort of hedge on this a little bit. We had one of our fixed income funds closed out, liquidated, the Lord Abbett Climate Bond Fund. So we replaced it with PIMCO's Climate Bond Fund. We added a private credit fund in there and another fixed income fund, which I'll talk about on the next slide. We switched out one of our alternative investment funds. These are funds that are non-correlated. We've talked about non-correlation in the past. So funds that aren't correlated don't move in the same cycles as the stock or bond market. And when you have volatility like we have right now, they tend to have a cushioning effect on portfolios. We make sure that we have those in every one of our portfolios. Of course, one of the things that I didn't include a slide on this, but I just want to reiterate to everybody that we are a sustainable investment manager. And so when we put portfolios together, we make sure that all of our equity funds are fossil fuel free. We don't want fossil fuels. We don't want to be investing in the cause of what we're trying to solve. So we don't invest in fossil fuels there. We've got what we call a core of our portfolio, which is large, mid, small domestic stocks, as well as international and developing markets. That's the core. But we have what I call thematics that really sort of bring the solutions concept of sustainable investing to the fore within these portfolios. One of which being energy transition, water, infrastructure, and biotech. And so those are the areas that really sort of make these portfolios, in my opinion, like truly sustainable. One of the things we did do is we bought into an investment called the RBC Blue Bay Access Community Capital Investment Fund, which is a mouthful. This fund is a fund that invests in community things like mortgage-backed securities, commercial mortgage-backed securities, SBA loans. What we're able to do with this is the fund manager, if we invest $1 million or more, which we did in this fund, we can actually choose where that money goes to. And so I was able to pick out, I believe, 16 counties in Western North Carolina that were directly impacted by Hurricane Helene. And so that money, that allocation, and I think the average allocation in our portfolios is 2 to 3%. So that money directly is going to come here to Western North Carolina, again, to things like mortgage-backed securities, commercial mortgage-backed securities, and SBA loans. We will get a listing of where all the money went. We just made this by, again, a week and a half ago, so we don't have that data yet, but we'll be sharing that with everybody. It's really, really exciting. The reason this was in front of me is at that Future Proof conference down in Florida a few weeks back. The representative from RBC, who I've known for several years, came up and said, "Hey, I have an idea." And we basically just took it from there. Like I said, it'll go to more MBSs, commercial mortgages, and SBA loans. So our core portfolios, our Green Sage, again, is always going to be all in stocks. And, our global equity has got just a touch of bonds. It's got that community capital note in there, or fund in there. Global equity, aggressive, balanced, conservative. You can see how stocks go down in each one of these and how bonds go up. Alternatives stay about the same. This is Nitrogen, which makes a software called Riskalyze. And they create risk numbers from 0 to 100 with, 100 being the most aggressive, 0 obviously being, keeping the money in a coffee can buried in the backyard or something like that. But you can see, conservatives 49, 52. We've got these spaced out really sort of where we want them to be. On the equity side, it's a little bit more conservative. On the conservative side, it's a touch more aggressive, but they've actually performed. We're happy with their performance over time. I talked a little bit earlier about alternative investments and being non-correlated. So we can see that this is a scale of returns on the vertical line here and volatility on the horizontal line. So ideally, you want to have a lot of return with as little volatility as possible. And so if we take a standard sort of 60% stock, 40% bond portfolio, and transition and add about 30% in alternatives, you can see it does two things. It reduces the volatility, but it also increases the potential return. And this is data from JP Morgan that we've used for quite some time. Having that non-correlated asset in there, again, especially during times like right now, really, really has a calming effect, or tends to have a calming effect on portfolios. So I'm going to go through the different funds that we use in our portfolios. Q1 performance was challenging and continues to be now that we are in Q2. Alternative investments helped with overall performance, but long-term performance in general is in alignment with our expectations. That is on a 5 and 10-year and since inception basis. Clean energy stocks continue to underperform since 2020, although we did see earlier that during some periods this year, it actually has performed a little bit better than the market as a whole. As always, we will make tactical changes mid-cycle if it truly is warranted. We did it during the pandemic. We did it during 2008, 2009. So that's not out of the realm of possibilities, but it will really have to be something that is really compelling for us to do that. And here you can see the different funds in blue. Orange are the different indexes that we use. So we can compare each one of these. Brown Sustainable Growth and Parnassus Core Equity, which is a new fund. The ones with the stars here are new funds. Have how they've performed. They're going to go up against the S&P 500. So we can see again, like I said, over the long term, we're happy. In the short to medium term, part of the reason why we brought in the Parnassus fund is because in the short term, Brown hasn't performed as well. So we reduced some of the allocation to them, although they still are a quality manager. We didn't want to get rid of them, but we certainly wanted to diversify in the large sector. I'm going to skip down here to international, developed international. We can see how nicely this Janus fund has performed in the first quarter. 7.5% versus its index at 686. And then you can take that out over time, and it's continued to perform well as well. Real estate performed well this quarter, as did emerging markets, you can see. Here is clean energy. Again, has not performed great, but again, if we look at this over a longer period, it's done well. Biotech, water resources, and infrastructure. Infrastructure, again, we see some short-term volatility, but we see some really nice long-term trends there. And when we cross over into bonds, again, PIMCO Climate Bond, that's the new one that we had to replace the Lord Abbett Fund with. We added this Bond Blocks Private Credit, and here is the Access Community Capital. Everything was pretty much in line with what we were hoping for or expecting. So we're comfortable with those. And then the alternative investments, like I said earlier, these are the things that have been really being a good buffer for our portfolio. So you can see that they've done well this first quarter. Actually, up and down the line here on this bond and fixed and alt side here has really been a nice complement to the stock performance. When we look at asset allocation, this is a 60-40 allocation between stocks and bonds. We can see that year to date that we're showing a negative, and going back to 2010, there's only a couple of years where an asset allocation was negative. 2022, which was a horrible year for both stocks and bonds. 2018 and 2015. So actually go to 2011 as well. So, but the majority of the years we were positive. So we'll see where we end up this year. I think that anybody who says they know where the market's going to end up this year probably has no idea what they're talking about. So, but I want to put this all into context. So this is a chart of the S&P 500 composite going back to 1900. And I'm going to skip some of the stuff that most of us didn't live through, but I'll start here with Black Monday. At the time, Black Monday was, the end of the world, right? But when we look at it over this extended period of time, we see that it really is a blip. We see that the tech boom is a little bit bigger. The dot-com era was a little bit bigger drop right there, but it's still a blip. The financial crisis, likewise, it really just sort of flattened returns for this period here. But then we started to see growth again. COVID-19, we thought the world was ending, and in many ways it did. It changed a lot of things, but from a market perspective, again, it was just a blip. And so here we are again. We can't quite see, or we don't see some of the drops on this because of when this chart was created. But ultimately, the reality is it's likely to be a blip as well. This is a chart that I show pretty much every single time, but it's just so important to remember. So this looks at the S&P 500 from January of 2003 through 2022. And over that 20 years, if you took $10,000 and invested it, if you kept it invested the entire time, you would come out with just shy of $65,000. If you had, um, let's see, if you had missed the 10 best days, so only 10 days out of 20 years, it halved your return down to $30,000. If you missed the 20 best days, it takes it down to 18,000. Missed the 30 best days, and you're only up 17% over those 10 years. Miss the 40 best days, you've lost money. 50 and 60, you've halved your money, less than halved your money. So the importance of not necessarily trying to time the market. I know it's hard. I know it's one of those times right now where it feels like the world is, might be falling because of policies and because of the market doing what it's doing. But we have to look, history has to be our teacher in this particular case. I had a conversation earlier with somebody about the whole concept of buy low, sell high even. And it's really, really easy to talk about buy low, sell high when markets are going up. But when markets are truly low, when markets actually have gone down, actually flipping the switch, actually hitting the buy button is so much harder when markets go down because we're scared. I mean, this is a scary time. Um, but it's also the time when true investors are made. And our job here as advisors for you is to maybe take out some of the emotion as best we can, to look for opportunities to maybe make the portfolio better if we can, but to make sure that we're not doing anything that ultimately will hurt us in the long term. So in summary, I'll wrap up here and they'll give us about 20 minutes for Q&A. We're going to continue, obviously we're going to continue to keep a close eye on everything. We will make changes if and when it's warranted. We've actually got a bunch of new business and referrals of late, and so we're really, really grateful for those for folks who have introduced your friends and family to us. Again, I said to our team on our Monday morning meeting that now is the time when our value really comes to show. Now is the time when we can really bring our expertise and bring our experience to the table for all of our clients. So we're grateful for all of you, and I want to say thanks to every one of you for your business. So we're going to move on to Q&A here, and so I'm going to stop sharing, and you can see my face again. All right, Q&A. We've got 3 questions. I think I addressed the first one. Great to address the insanity that's happening. I think if you're talking about the tariffs, I think I covered that as best as I can. Has values-based investing of Earth Equity changed at all with the acquisition merger from Prime Capital? No, they don't have anything to do with our investing process. They don't have anything to do with which stocks or which funds or bonds or whatever it is that we pick. That is still all done right here with our team. So no, there's no impact from them. Any other questions? I expected to see more. Please put them into the Q&A box. Neil, are there any questions that your clients are asking you? Actually, I got an email from a gentleman the other day asking why prior to the tariffs being announced, didn't we move more money into cash? And I think I sort of explained it when I was talking about the time in the market versus timing the market. But the reality is that we understand that over time that these things are going to happen, and our job is, again, to take the emotion out of it. Our job is to really look at it as best we can based on our experience. And sometimes it's okay to move to cash. I don't think that we are there yet. Doesn't mean that we won't be soon, but that's a possibility. Um, let's see. Thank you for not joining the panic. You're welcome. Is there a way to see our portfolios in real time or quicker than it appears to be a delay? I think when you log into Fidelity, that's about as fast as you're going to be able to see it, without setting something up externally, say in like Yahoo Finance or something like that. But I think that's about it. Can you talk a little bit more about opportunities with international stocks right now? Um, we have moved, I want to say it's probably about an average of 5% from domestic to international. The majority of that is in developed international. So you're going to find that in the Eurozone, Japan, and, you know, that's Canada. So you're going to find that money going to those. We just think that it's going to be a little bit more stable. We think that in an environment where the U.S., I don't want to use the word pariah because that's not the right word, but where the U.S. Maybe has a stigma attached to it because of these tariffs, that those regions are probably going to be forced to come together to really sort of bolster themselves. And, that's possibly where there's an opportunity. The other thing, and I don't have a chart for this that I can show. I have the chart, but I can't show you right now. But when you look at valuations of international stocks relative to stocks in the U.S., international stocks are tremendously undervalued relative to U.S. stocks. In fact, I used that particular chart last quarter saying, hey, I think that there's going to be an opportunity coming up. And, here we are now. We've actually made that shift. But, I think those are my thoughts on international. Um, any pressure from Fidelity? No, Fidelity has no pressure on us for what we choose to buy or sell. They are a completely neutral organization. They hold our portfolios, and that's it. So no, there's no influence whatsoever from them. The nice part, so we transitioned from Axos to Fidelity 2 years ago when we made the transition to Prime Capital. And the good thing about Fidelity is we have a wider variety of securities that we can use. And so, I have always loved the people at Axos, but this really gives us a chance to serve clients a little bit better, both from access to different securities, but also we have margin now. So for clients who would like to be able to use margin or have the flexibility to use it, we can use margin, which we couldn't do at Axos. Do you feel it would be helpful to join in some of the voting emails? Let me know if there's some leadership worries. Um, on the political side, you need to do what you feel is in your best interest. I think that there's going to be lots of opportunities coming up during the midterms, and so I would probably keep my eyes on that. Is there an online reporting link that focuses on the kind of investing EEA applies, and would that sort out what is happening for us versus the traditional markets? I mean, we have a reporting system called Your Stake that can show you the impact of portfolios. It doesn't necessarily show performance or returns. And the reality is shy of just pure clean energy, which is sort of, wind and solar and that kind of thing. Sustainable investing versus traditional investing is pretty competitive. And so, remember that when we invest sustainably, you don't own, 100% solar or anything like that. It's a piece of the puzzle. The only sector we don't own is the fossil fuel sector. And so, fossil fuel stocks, like, for example, over the past week or two have gone down tremendously because, oil has gone down. And so, they're going to trade with the commodity maybe a lot more than they would anything else. Do you believe this strategy was a tactic for the ne'er-do-wells to grow their wealth, insider trading? I've heard that. I really don't have an opinion on it. Yeah, I really can't comment on that, because it's rumors. So, any additional recommendation for client planning to retire this year? Yeah, I can certainly empathize with you. Um, Theoretically, if you've gotten closer to retirement, you probably would have made your portfolios a little bit more conservative, so a little bit less on the individual stock side, which, as we've seen, bonds have done well this year. Bonds have done well over the last year, yeah, over the last year or so. So, if you've moved into that kind of a position, that's what I would say. If you haven't, you're going to have to ride it out, is really about the only thing I can say. Thank you for a great summary. Where the quick reverse policies and hints of future moves magnify the swings in the markets and increase instability and uncertainty for investments. You're spot on, Robert. The reality is that the market does not like uncertainty, and there's a lot of uncertainty right now. And we're going to see that for a while until we know what's going on with tariffs, until we know what's going on with economic policy. Where's inflation going to go? What is the Fed going to do with interest rates? Are we going into a recession? Nobody can answer those, no matter what they tell you, and how many letters they have after their name. They're not necessarily going to be able to answer that question. All we can do is be as well diversified and as well prepared for it, and do our best to match you to the risk tolerance that you have. Laura was talking more about companies' voting requests. Yeah, we are in that season. I'm getting a whole bunch of voting requests. There's not a whole lot in there that's going to impact anything that you're dealing with, relative to the economy. Some people like to vote no against like executive compensation because they feel, and rightfully so, that most C-level folks are overpaid. Um, but for the most part, there's not a whole lot that's going to have an impact on. Will an investor lose out if changes are made in our portfolios now to lower our risk? Um, yeah, I mean, if you sell now, you will lose where you were, but ultimately it depends what you're going into. So if you're going from, say, a stock into, say, a structured note or something like that, that has some certain level of yield associated with it, theoretically, you may not be losing out because your opportunity for yield may make up for that difference. I mean, remember, over the last year, we're still pretty close to flat. We're probably down a little bit today, on the 1 year basis. But, again, when we break this out over a much longer period of time, uh, I hope, we really can't say for sure, but I hope that this is a blip, just like we saw for those examples I gave you. This administration is anti-renewables. What do you think? The short answer: medium impact on those stocks. I was on the phone with a reporter earlier today, and she was asking me about, um, let's see, she was asking me about, you know, about climate, or about renewables and things like that. And, her question was, uh, during the first Trump administration, we did really well in renewables, and during the Biden administration, they did really bad. There's no rhyme or reason. Market forces are going to move clean energy in whatever direction is going to move. Yes, there is some government involvement with tax credits and things like that. So far, we haven't, knock on wood, we haven't seen any motion, to get rid of those yet. I mean, there's been a lot of bluster about it, but we haven't actually seen anything happen. So, um, my hope is that on the corporate side, we're probably, and I don't know if you guys have heard of this phrase. It's called green hushing. And so, the greenwashing is one thing. Is when you say that you're, a green company, and then really aren't. Green hushing is where, we run into this kind of a world where, DEI is a bad thing, and all these others. you keep doing it, you're just not advertising that you're doing it. And I think we're going to see a lot more of that because companies understand that having a diverse workforce is really important. Companies understand that pulling your energy from renewable resources is really important. Companies understand that retrofitting your buildings so they're more energy efficient is in their best interest. So, but what might not be in their best interest would be advertising that. And so we're likely going to see some more of that. Scott, you asked a great question. The people holding Future Proof Conference realize the irony of holding a conference with that name on Miami Beach, which is forecast to be swallowed by sea level rise. Great question. The guys who host this, or the folks who host this, are not sustainable investment managers. We just happen to be like I was one of two people who were experts there on it. I will be at one of their events in Colorado Springs in a few weeks, and I actually will pass that on to them. I think that's interesting. Do you think it makes sense to invest in money in ethical gold ETFs or any other similar securities? I'll start out by saying I'm not an expert in gold, so we'll start with that. Traditionally, during times of uncertainty, gold has been a stabilizing factor. But I would say if you are in our fund portfolios, you are going to have some commodities in the alts section of the portfolio. So you're probably going to have some in there. It's not going to be a huge percentage. It's probably going to be like less than 1%. I don't know what you would pull money from to put it into gold. Remember, gold doesn't have a yield. So, if I'm going to switch over, I would much rather switch over into something that actually has a yield versus something that is just a commodity. Is there even such a thing as ethical gold? I don't think that there is. But you can invest in gold as a commodity versus investing in the gold miner. The gold miner would be much less ethical than investing in gold futures, which would be not actually owning the gold per se, but owning a future on what you think the gold is going to be worth at a certain time in history. Bank money market accounts are paying 4 to 4.5%. Any reason to invest heavily there? I think that, and I personally do this, make sure that I've got at least, a certain amount of my, annual expenses that are in a bank earning 4.5, right now about 4.5%. Those are great rates. They have come down some from their highs last year, but there still are, great opportunities like Climate First Bank, for example, has one of the higher rates in the country. So, I'm not necessarily sure I would pull anything out to put it into those right now, but, with any cash you have, shop around and find the best rate. Like I said, the one that I found is really good is Climate First. That's done really, their yields have been really good. Yeah, so I think that answers that. Let me go through and see if I missed anything here. Don't see anything else. Any other questions? You guys have thrown some good ones at me. I don't have all the answers, but I've got 27 years of experience in this business now, which makes me feel really old. And I appreciate everybody who's taken the time to hang out with us here. I know I'm seeing we have 36 folks that are on, and thanks for taking an hour of your day today to talk a little bit about this, to ask questions. If you have any additional questions, please feel free to reach out to me or Neil or Carrie. We're here to answer any of your questions. If you're not a client, please reach out. We would love to help you invest sustainably. I think you got a little idea today of how we work with folks and what our philosophy is. So, thanks again for your time. I'm looking to take one more look. No more questions. And I will wrap it up. Thanks and have a great day.